Recording in progress. Hello, hello, hello. Can everybody hear me?
Good evening, yes, sir.
Fantastic,
Good
fantastic.
evening.
All right, welcome aboard. Today is D-Day. This is our last session before your midterm next week. So I hope you guys spent
Okay.
the weekend studying and reading and studying so that you can be more than ready. A little bit of housekeeping. First of all, the exam, midterm, and final are in-house. So those of you who are here in New Providence, you have to report to BIFS next week at 6 o'clock. You'll have the usual class time to do the exam. You probably won't need all of that time, but you will have it just in case. Okay, from 6 to 9. Those of us who, of course, are not on the island will be present in the exam as well with everybody else, except that you'll be doing it electronically. Okay? So our friends in Montserrat will be right in the classroom with you, staring at the adjudicator, whether it's me or someone else, while you sit patiently and get your A's and B's next week. Okay? Any questions before we go on?
Could you repeat that again? You're saying the persons who are Nassau have to come to the office on Shirley Street to take the exam?
Yes. For those persons who might be in the Family Islands or elsewhere, you will be in the examination, but you will be doing it electronically. Obviously, you can't fly here to do it. For those who are in New Providence, will have to come to BIF's office, the classroom center on Shirley Street.
Good afternoon, everybody. Good afternoon, Mr. Wilkinson. I just have a question in terms of the layout of the examination.
Mhm.
Is this multiple choice? How is the format of it?
The exam will be definitions and short answer questions. No multiple choice.
Okay, thank you.
You're quite welcome. So basically, if you can define all the various types of terms that we discuss, and a lot of them you'll know from experience or just from our discussing them, in addition to whatever you learned going along the way. If you can define stuff, I'll say, what is the definition of this, this, and this? And then the second part of the test would be short answer questions like, what are the two components of loan structuring? What are the 5 C's of credit? And so on. So pretty much pretty straightforward. All you need to do is have the information at your fingertips so you can just go ahead and write it down. Okay. I will not be asking any questions out of the blue. They will all be questions based on our material and our discussion. So there wouldn't be anything from the fine print from some other document. Okay, no surprises like that. All right. Any other
Also, I hope I'm not asking too many questions, but
No.
how was an estimate of how many questions is on this midterm?
10 to 12 short definitions and 12 to 15 short answer questions.
Okay.
Yeah. Usually my definition questions are worth either 1 or 2 points, depending on the definition. Usually one. Short answer questions, you get a 1 point for every correct response. Sometimes my short answer question is just one question. What time of day is it? Yes, sometimes it might be a combination of 2 or 3 questions into one, like what time of day is it, what day is it, and what day will it be tomorrow? And so you might find a short answer question like that with 1 part, 2 parts, or maybe in rare cases, 3 parts. You just go ahead and answer each part correctly, and typically you get a point for each correct answer you give. Okay. So if I have question 1, 3 parts, and you answer all 3 correctly, you get 3 points. If it has 1 question and question 2, and you answer it correctly, you get 1 point. And then I add them all up and come up with your total grade. Okay. Nothing fancy, nothing complicated. All you need to do is go ahead and put all those correct answers that you already know onto the paper and make my life heaven by just marking ticks.
How far are we stopping today with the booklet so we'll know how far we are to study for this midterm?
Well, we're gonna go and run right off the road probably today. And wherever we stop today, I will not hold you responsible beyond where we stop today. Okay, so let's just keep on rolling, and wherever we stop today, that is what I'll hold you responsible for. Unless, of course, there are 1 or 2 pages I think that you can do without any blah blah blah, and I'll say, okay, go up to the end of this. But typically, it'll be where we stop. Any other questions or concerns as we get ready for next week? Okay. All right. If you think of anything along the way, please feel free to interrupt me. Or, well, if your colleagues are reading, you can read until they're done, but you can interrupt me anytime when I'm yapping. Okay, feel free. All right, Tonique, are you with us tonight?
I'm here every night.
Okay, that's what I'm talking about. Absolutely. Way to go. I like to hear. I'm here every night. Okay, Nigel. Nigel able to make it out tonight?
Which Nigel?
Nigel, there you are.
I don't know if he was meaning the next Nigel or this Nigel.
I'm sorry. I'll go down to Nigel McKenzie and tick you right now, Nigel McKenzie.
Yes, sir.
All right. Actually, I was trying to Nigel Conliffe, but that's okay. Now I have Nigel McKenzie ticked in. Nigel Conliffe is dealing with some issues. That's probably why he's not here. I just hope he has the opportunity to do his review and be able to join everybody next week. Okay, Lisa Esfaques, are you there?
Yes, I am.
Okay, Lisa, welcome aboard. Ready for next week?
I will be.
Don't worry, it's not going to be a big deal. Okay, so just do your normal stuff and you'll be fine. Okay, Juliet.
Good evening.
Hi, Juliet.
How are you?
Just fine, just fine. Ready for next week?
Nope.
Nope. Okay.
Nope.
Now that's what I call an honest answer.
I hate exams.
I know. If it's any consolation, so do I. I'm just happy it's you guys and not me. I have written 10,956 gazillion examinations. I hated them all.
Oh my gosh.
It-
Go easy on us now, okay?
but I won't be unreasonable. My objective for you guys in this session is not to see how fabulous you are at passing your examination, even though that's very important, but to let you walk away with as much information that can be helpful to you. Okay. The
Correct.
examination for me is just to keep you committed, so there shouldn't be anything
Correct.
out of this world. Just do your
That's-
normal study, make your normal commitment to the study, and you should be fine. What I don't want you to do is say, oh, that's going to be a piece of cake. I'll just go by what we did in class and a few things here and there. Just don't do that.
Okay. Okay.
Okay? And
Everyone.
you'll be fine. Okay. Philip, are you there?
Yes, I am. I'm ready.
Philip, welcome aboard. You ready for next week?
I hope next week ready for me.
Point well taken. It doesn't sound like you guys did a whole lot of stuff on the holiday weekend. That was your time to.
The holiday weekend was like,
What happened to it?
yeah, There was little chill.
Lady Phil. I know,
Any rain is on the holiday weekend.
I know, no encouragement to study. And no encouragement to sleep. All right, I know, that's the danger, okay, for sure. All right, Marissa,
Yes, sir.
okay, right there, way to go. And, okay, Walter,
Yes, sir.
Walter, did
Yes,
you guys have any holiday weekend, this holiday?
yes. We had a long holiday weekend.
You guys had the Friday, Monday thing?
Yeah, we had it from Thursday, Friday, and Monday.
Wow. So you and the Lally have no excuse then for next week.
That's separate and apart.
I wouldn't say that. Okay. All right, welcome aboard. Delali, are you there?
Yeah.
Present, please.
There you are. Okay. Did you do anything productive with your credit collections this holiday weekend, Delali? Thursday, Friday, Saturday, Sunday, and Monday?
I did a lot of resting, yes.
Okay. I know. Studying, all that stinks actually, but it's a necessary evil. All right, well, let's get cracking then, see if we can get through this evening. And so you guys can be off and running to prepare yourselves for next week. Okay. Walter and Delali, you may have heard, I hope, your examination will be virtual, but BIFs will send you the usual connections, have you hook up in the classroom with everybody else. So they'll be staring at you and you'll be staring at them in one form or another. Everybody will be in the same room in one form or another. So just be prepared to do that. They will give you all the instructions that you need in order to do what you need to do and how to get your examination in when you're done. Okay.
Okay.
All right. Okay, so let's get cracking then. I think the last thing we were talking about were the different types of loans. I think we said that credit cards themselves are loans. And sometimes when people go with their credit card to get cash advances, they think that it's kind of like a debit ATM transaction, but it's not. Every time you use your credit card, you're borrowing money. The balance increases and gets bigger and bigger and bigger. And then those big interest rates are added until you can pay that credit card down to a reasonable amount or zero. Question, should we pay our credit cards off in full each month? Anyone?
Say that again.
Should we pay our credit cards off in full each month?
Yes.
That would be
That's the
ideal.
Some people say yes, some people say
Yes.
no. Yes, okay. Any no's?
That would be ideal for the card holder.
Yeah, absolutely. Absolutely. For those of us who can do that without impacting our cash flows in any way, then we should do that. It's economical to do that. Some of us, though, cash flow is going in so many directions. And if you have children, it keeps changing direction, change your whole life. You can't even plan with your plan. You budget, if you have a budget and that doesn't work. And so we can't pay off any credit cards anytime soon. We're just happy to pay the minimum balance and suffer the consequences until some future date.
Nope.
Sorry?
No, can't go with those high interest rates.
No, if you can avoid them, you avoid them at all costs. Okay? But despite that, Walter, people still are happy to say, thank God the minimum payment is only $30. That's all I'm paying this month. I have too many other things to pay. But if you cannot do that, don't do it. Go ahead and pay it off. Save yourself some stress. Okay? In terms of those interest payments, those credit cards will murder you with those interest payments. They don't talk about them a lot. They just keep encouraging you to use the card. Use it, use it, use it, use it. We'll give you a toast if you use it. We'll give you money if you use it. We'll give you prizes if you use it. just use it. Okay, so be careful. All right, and then of course, on page 18, we have small business loans. I think most of us would have heard about small business loans. In the United States, for example, we have the Small Business Administration, which is designed to help with small business loans. In the US, in the Bahamas, we have these days Access Acceleration, where small business people can go to make arrangements to borrow money. The whole idea is these are typically business loans, and business persons who want to go into business, for example, for the first time, or persons who have their existing businesses and need to borrow money, they can go in to seek financing for small business loans. Okay. Usually, if you're looking for business to start a new business, you need a business plan. Take it into the bank will check it out, see how long you want it for, find out if you have any personal guarantees since they're lending you money for the first time, all this kind of stuff. Do you have any assets to put up as collateral in case you don't pay, etc. We are told in this text that these loans can go up to 25 years, but most lenders don't want to do that for a business loan. Okay, they want to do that for mortgages, but not business loans. Business loans typically tend to go 5, 7, 10 years max. And if somebody's your friend or your relative, they might take it to 15 years. All right. Interest rates are sometimes. Question? Say it again. Walter?
No, I don't. Probably some outside now.
Yeah, I had a little stuff coming in. Okay, no question though. All right, and of course, for small business loans, interest rates are usually negotiable. They can be fixed, meaning you can have 10% rate for the full time of the loan, or they can be variable, meaning just like some mortgages, if the market rate changes, then your interest rate change, and so will your payment. Okay, so these are some of the components of getting a small business loan. And for some companies, especially those who are already in business, for example, if Christmas is coming and they don't have the money to buy inventory, they might go into a financial institution to borrow money to buy inventory for the Christmas holidays because people are going to shop. And then, of course, once the shopping is done, they go in and pay off the loan or pay off the overdraft or just continue making the payments for the full year or 3 or 5 years, depending on the facility they have. The point I'm making here is that loans tend to be very flexible, and depending on the type of loan you want to make sure you find yourself with the right lender so that you can get the proper structuring done. Which takes us to the next point called loan structuring. Loan structuring, and for those of you who would have read ahead, which I hope you did, loan structuring pretty much is how we set up the loan. What kind of loan are we going to give? How are we going to accommodate borrower? What is the best type of term and amount and interest rate that we're going to negotiate on behalf of the bank and the borrower? This structuring is very important because sometimes lenders lend borrowers more money than they should lend them, and they choke to death, and the loan goes bad. Sometimes borrowers insist on getting an amount of money that's not enough. They underborrow as part of the structuring process, and any lender that allows a borrower to underborrow, they find out eventually in a couple of months or a short time after the loan is done that they did not borrow sufficient, and now the client is back to borrow what they should have borrowed in the first place, which would be the remainder of the money, which of course puts the lender back in square one. We just did this 6 months ago. Why didn't you say that you needed this amount? And then the client, well, I wasn't sure. And then the lender says, well, I had a feeling and I should have given you the amount you needed. And this is all part of the structuring process. Okay. Sometimes it works well without any hiccups. Other times, people come back because they underborrowed. They come back because they find that the payment was too high. They thought they could afford the payments. They can't. So this lending thing, as you can see, It's very, very dynamic. There's no hard and fast script. We have the principles of lending, which is what we're discussing this semester. And next time, for those of you who do part two. But those principles are these are just guidelines. Over time, as we become more experienced in our jobs, you'll find that we will flex these principles and these rules and this academia, because the real world requirements are oftentimes somewhat different from the text, obviously. Okay? So, in structuring a loan, then, we need to consider two very important points. One, something we call product selection, and two, the loan itself. Okay? So, what is product selection? When you choose a mortgage or a loan or any type of facility, in this case, we're looking at the mortgage. And this for our persons at Bahamas Mortgage Corp. We'll be happy about this. You need to be considering in your decision making to give a mortgage a few things, and those things need to revolve around your clients. For those of you who do mortgages with Bahamas Mortgage Corporation, for example, those clients that you have are not the typical run-of-the-mill clients. They are a unique group of people who are coming in to borrow what we call for lower cost homes through the government guaranteed plan, and therefore they have different expectations and all kinds of other unique features. Okay? Quite different from the other person coming off the street to buy that what we call typical home that we don't consider to be low cost. And so the terms and conditions and structuring will be very different for them. Even the lender's attitude towards them will be different from the attitude towards those persons seeking lower cost home. So
Okay,
all
let
of
me
us-
just can I just interject there for a moment? Just one
Absolutely.
second.
Mhm.
Bahamas Mortgage does not only cater to persons looking to purchase government initiated homes.
Yes.
We can also finance a piece of property for you.
Okay.
We can also finance a piece of property and the building if you so choose.
Yes.
It's all based on what you're qualified to borrow from us. We can also purchase an existing building for you.
Yes.
So it's like not just government initiated.
Excellent. Thank you so much for that, Tony, because I'll tell you,
In the event that anybody wanted to, check us out.
yeah, I have a guy now. Good thing you said that. Do you guys finance commercial property?
No, sir.
Oh,
First
God.
time homeowners, Bahamians,
Okay.
or you can have permanent residence. And no, we don't encourage triplexes. It's just a single dwelling home
Right.
that you're going to live in, preferably.
And no commercial buildings whatsoever.
No, sir.
How unfortunate for those persons, but yes. Okay. Thank you for that update. So it's not only low cost, but first time borrowers, single family homes typically doesn't have to be a low cost home. If you're a first time borrower and you want to buy a $300,000 home and you meet the requirements, you can do that.
Definitely.
Okay, perfect, perfect. So somebody else may have been enlightened, because whether you're aware of it or not, a lot of people in the Bahamas feel that Mortgage Corporation caters primarily and only in some cases to persons who are seeking low-cost homes. And of course, low-cost home is a relative term, isn't it, Tony? Because but once upon a time, a low-cost home was like an $80,000 home.
You're not gonna be able to purchase anything
Mr.
for
Wilkinson.
80,000.
Hey,
We don't call it low cost homes no more. It's affordable homes now, sir.
affordable
No.
home.
Yes,
Yeah.
we changed the branding on that, sir. Yes.
Thank you, Big Nige.
You guys have been doing a little branding. Yeah, thank you for taking me out of the dark ages. That's what we called it once upon a time when I was Nigel's age. So yes, affordable homes now. Okay, way to go. But yeah, a lot of people still think we're talking about something under $100,000, and I don't think that's the truth anymore, is it?
No, what you're gonna find for $80,000 is not By the time you're gonna need at least $50,000 to $60,000 worth of repairs to bring it to move-in ready.
Yeah.
Yeah.
My. Inflation. That's a strange creature. All right. So yeah, thank you for that update. Maybe some other persons are enlightened as well. And maybe now they might go and tell somebody that you guys do other quote unquote kinds of homes other than affordable homes. And if they want their first time borrower, they can go there.
Yes, a down payment is 5%, whatever
Nice.
the actual loan works out to be. And we
can-
also have an interest rate of 6.25%.
You guys are very competitive with the commercial banks. So people can now come to you guys and go to drive past Royal and leave smoke in the door and just drive straight to Sweetland and get the home. that first home sounds good. All right. So those of you who didn't know before, or even if you don't need it, tell someone, because a lot of people don't know that. Okay? They really don't. All right, then of course, so that's in terms of product selection, we're just talking about the type of loan we're looking to give and get and the terms and conditions surrounding that loan and making sure that the package for that particular product is unique and structured in the best interest of the lender and the borrower. That's really the key. The other thing, other than the product itself, is the loan itself. Okay? How is this loan going to work? What is the security going to be? Is it going to be one type of collateral or more than one? Okay. What is the lender going to require? Can the borrower provide this requirement? Okay. This is all the discussion with regards to the loan itself, not just the product or type of loan that you're getting. What kind of facility will it be? Will it just be one fixed term? Will it be something you can refinance if necessary? Will there be principal and interest payments or interest payments only? So again, there's a whole lot of flexibility depending on the institution and the loan itself. But these two key areas are what we refer to as the loan structuring areas, and everything else revolves around them in terms of the product selection, and two, the loan itself. That's a nice test question. What are the two major loan structuring? And then you just distance. We just did that last week. I remember that. All right. And so you can see from the text that loan structuring is really tailoring the loan so that everybody can be happy at the end of the day. And who's everybody? The lender and the borrower. Okay. We are told that one of the big problems with borrowers is that sometimes they don't understand that they can do all kinds of things with their loan facility. They don't realize that it's more than just a transaction, that there are things that can be done in their interest. A lot of times lenders don't tell them everything, borrowers don't ask the things they need to ask. And oftentimes it costs them lots of money in terms of maybe interest payments, for example. If you get a longer term loan, the interest will be more. If you get a shorter term loan, the interest will be less. However, if the loan is long term, the payments will be smaller. If the loan is short term, the payments will be bigger. We assume people understand that completely, but they all don't really understand it. Okay. Part of the structuring process is to create that understanding, find out what customers are not aware of, tell them what they need to know. Don't deliberately not tell them. Okay. For sure. Because customers oftentimes don't know a lot more than you think. And they need to be, as we say in the Bahamas, educated. They need to be educated in terms of what they're coming in to borrow and what the real terms and conditions and structuring of that loan are and what it means for them in the long term. And again, a lot of borrowers don't realize that all lenders are not the same. A lender by any other name is not necessarily a lender, and customers oftentimes don't know this. Financial advisors, that's why they exist sometimes. Do we have financial advisors in the Bahamas, anyone? Do we?
Yes, we do.
We do? Where can we find them?
There's Miss Tennessee Bow at Fidelity.
Okay, so there's
He's an
somebody, there's a physical.
awesome financial advisor.
Okay, so does he provide free services to the poor? Downtrodden?
I think you'd have to probably be a client of Fidelity.
Yes.
I'm not sure, but
Yeah.
I'm thinking that's how it works.
Indeed. In other words, we don't typically have like persons in separate offices that just.
That was
spending-
not that I know of.
Yeah. Interestingly enough, you'd think that we would have that kind of stuff by now, but we don't. And maybe part of the reason for that is they'd be competing fiercely with the persons who work in the major financial institutions, like lenders themselves, who oftentimes would and should provide this information to their clients, which means that they don't necessarily have to go to an independent financial advisor outside of the financial institution. Most people feel that if they want financial information or help, they can just ask their banker, their credit union person, or whatever. And to a great extent, they are correct, because these persons are indeed financial advisors in their own right. But in large countries, financial advisors do pretty well in terms of, like psychiatrists, for example. You come in and you present your financial situation, and they tell you the best way to resolve your problems. Maybe we do need something like that somewhere. All right. So good structuring is very important because when you're structuring these loans, whatever type of loan it is, we saw so many of them earlier, the different types of loans. We have to, as lenders and borrowers, we have to know that there is risk involved. For the lender, definitely there's credit risk that eventually the customer will get tired of paying and say, I'm tired of paying this loan and stop paying it. Or I'll pay it whenever I feel like and pay it late every month, or whatever the case might be. That is part of the risk. Okay. Or they might leave the country and never come back ever. Just you have to write it off. Okay. But we try to keep that to a minimum, hopefully. But for the most part, we look at good structuring, good designing of the loan, good financing structures, so that the borrower is not choking, suffering, paying too much in interest, paying interest rates that are too high, and all this kind of stuff. And certainly, the lender wants to make sure that the borrower is a good risk person, whether it's an individual or a company, and that they have the ability and the facility to repay the loan. Okay? Even in some cases where adverse circumstances occur, they have some kind of backup, maybe a spouse or guarantor, some such person who can kick in. We talked about guarantors and guarantees. That's a nice test question. Differentiate between guarantor and guarantee. Are they the same, anyone? Guarantor and guarantee.
Not the same.
Are they the same?
No, they're not the same.
No, they're not the same. Okay, so if anybody's still stuck, go back to that section we talked about last time, and you'll see what Walter means when he says they're not the same. Okay, be careful with that one. So I ask that, don't make sure your answer is not, but they're the same. Okay, because they're not. Very subtle difference between the two of them. You would have seen under the benefits of loan structuring that structuring involves a couple of important elements, such as the purpose of the loan. A lot of people don't, and again, the essence of all this stuff becomes clear after you get involved in the actual process of lending. We do the academic stuff to remind us of the existence of the things we ought to be aware of, but the actual practice of lending oftentimes takes us into very specific areas outside of the macro learning that we're doing now, into very micro sides of the lending process, depending on the type of lender we are. Okay, but a lot of people still don't understand the importance of the purpose of the loan. They think it's just something in passing, like, what is the purpose of this loan? That is a very important question, and the answer you get from the client is a very important answer. And you need to make sure that you ask that question clearly and that what you get back is what you want to hear in terms of what that customer is looking for. That's a serious part of the loan structuring process. Okay, what is the purpose? What is the amount? See, that's another thing. Remember, you don't want to lend the customer more than they need. You don't want to lend them less than they need. You want to lend them what they need. Okay, so the amount of the loan is very important as well. Type of loan, okay? Purpose, amount, type. Man, is this going to be a revolving loan? Is this going to be an overdraft? Is it going to be a mortgage? All these things are critical, okay? Because how we ask and answer these questions has a lot to do with whether we're going to recognize the risk involved in that particular facility and to consider what mitigations we can do to try and keep our losses potentially to a minimum. Also, answering these questions in terms of the loan structure helps the lender to come up with proper pricing of the loan, what interest rate we're going to charge, what kind of documents you're going to have this customer sign so that the bank's position is protected for whatever reason. Okay? So all of these are considered part of the loan structuring process. Okay? So if I were to say to you what elements are involved in the loan structuring process, then you just blurt them out. That's it. And that's what I mean by short answer questions. There's not going to be any strange aliens. It'll be stuff that you would have heard and or read. That's why I said previously, just keep going over the stuff, study, review, study, review. If you do that, it'll be hard. And if you get to a point when you're reading and studying this stuff, you're like, I'm sick of it. That probably means you're almost ready. Okay? It's usually when you get sick of it, that means you spent quite a bit of time with it. All right. Now look at some of the sub-elements of a good loan structuring process. Okay. First of all, we're down to page 20. The loan must satisfy its purpose. See? So we have to make sure that the borrower is borrowing exactly what they need to borrow and the lender doesn't do anything more. The reason for the loan, the purpose, the whole list of things. As you can see, I just threw them all in there so that you can see the kinds of purposes that people and entities borrow for. It's a long list, from working capital to pay the day-to-day bills, to make payroll, to pay rent, to pay taxes, to pay vendors who they purchase stuff from on credit, to buy new equipment, to buy a new car, to buy property from Bahamas Mortgage Corp, to buy a home if you're a first-time buyer from Bahamas, like that. Okay. And so whatever the loan is, it must satisfy the purpose. Otherwise, both the lender and the borrower are going to have a problem eventually, for sure. Be sure you are lending and borrowing the right amount. That's almost self-explanatory for some of us. Maybe for other people, they may not get that, but there's a reference to a little bit of wiggle room in some cases. In other words, if customer comes and says, I need $5,000 for medical expenses, say, wait a minute, medical? Maybe, but maybe you should throw another $1,000 or $2,000 in there because medical bills tend to get weird. And so instead of suggesting $5,000 that the borrower came for originally, you might say perhaps you might want to take a little wiggle on this one and borrow $6,000 or $7,000 just in case you have any contingencies. Okay? Those are considered the exceptions to the right amount, but typically we do want to give the customer what they need exactly. Lending should never be excessive. They shouldn't be getting too much or too little. Either way, it jeopardizes the loan, the lender, and the borrower's position. The right amount, very serious stuff. All right, collateral. Very important. Most banks don't want to. Question? Okay, most borrowers don't want to lend unsecured, give unsecured loans. Borrowers don't mind getting an unsecured loan with no collateral, but lenders hate that. It's typically, as you now all know, If there's no collateral and the loan goes bad, the lender has nothing to repossess, to take possession of in order to recover its outstanding balance. Okay? So they're always looking for some kind of collateral, which is why when you take the application that you would have seen later in this text, hopefully everybody looked at that. Most of you might be, some of you might be familiar with that kind of application and more. But typically collateral is there as a backup in the event something goes wrong, the client does not and cannot pay. Even with revolving lines of credit, like credit cards, for example, typically lenders do not ask for collateral for when they issue a credit card. Some institutions, if you're getting a credit card for the first time, depending on the institution, they might say, okay, we're going to give you a small credit limit, $1,000, $2,000, and we'd like you to put a cash deposit, cash collateral of $1,000 or $2,000, just in the event that we see how you manage the card, and perhaps we might let it go. Okay. But typically, lenders are looking for collateral. Most times, lenders are not keen to give loans without looking to get collateral. So when you fill in your loan application, one of the things they want to have a section called assets. And the reason why they have that there is so they can see what assets you have and what possibly they can use as collateral. If you go to a lender and say, can you fill in the asset section? They say, I have none. That is not very encouraging. That doesn't mean you won't get the loan, because of course the loan might be for what? First time property. So now you're going to be getting an asset, right? And so it might be for your first car, second car. And so now you're acquiring an asset. So not having any assets doesn't disqualify you, it just depends on the purpose of your loan. Now, if you say you have no assets and you want $10,000 to go to visit Israel and walk on the Red Sea or something, then that's a whole other problem, okay, for the typical lender. All right. Of course, let us not forget, we talked about it earlier, the term of the loan simply means how long the loan will run for, nothing exotic. And terms are very important because the lender wants to make sure that the borrower gets the term that is best suited for the borrower and best suited for the lender. Okay, they don't want to make it too short or too long, depending on the purpose and amount of the loan. And so oftentimes lenders, in making their decision and structuring a loan, are oftentimes thinking about what term is the ideal term. Should I give them a year, 3 years, 5 years, 10 years on this particular facility? Let's not forget the risk issues. I don't think when borrowers are going in to borrow, they think too much about the risk unless you're a certain kind of borrower. Maybe you are a borrower who's a lender, so you're looking at the risk side of things. But most borrowers are not looking at risk. The lender is looking at risk, okay, and how they can mitigate those risks. What are the chances that these customers, some of them will not repay this loan? And if they don't, what are we going to do? And usually there's a structure in place to deal with that. Okay, that's the delinquency department. That's a contingency already accounted for. The delinquency department is designed to go after people who don't pay or who pay late, okay, to try to make sure that the bank's money does not stay out there too long without being given attention to. So you'll find if you're a couple of days late, somebody from a financial institution somewhere, from their delinquency department, or collections department, or recoveries department, whatever we call it, will call you and remind you that your payment is due, and where it's late, that it's late, and to ask you to please come in and make the payment. Then they'll make a little note that you were late, which might be reported in the future to the credit bureau, and to see how many times you were late for this payment, and that goes into your credit history. See, so it's a vicious cycle, and the bureau is going to create more viciousness, which of course financial institutions are not unhappy about. They're happy to hear that. Many borrowers, though, as I mentioned previously, are going to have the horrors. Because now they're going to be quote unquote discovered. And many times when they're discovered in their poor credit histories, for whatever reason, then it's going to be extremely difficult for them to borrow. Pricing, let's not forget that. Pricing is really what rate of interest typically the financial institution is going to impose on a particular type of loan. And so a well-priced loan is good for borrower and lender. We don't want to overprice it, quote unquote, whatever that means. Some borrowers don't see what we understand what we mean by overpriced. They want to maximize their returns. And the informed lender obviously is looking to make sure that their loan is not overpriced either. Okay? We're all looking for the lowest possible rate on loans and the highest possible rate on CDs and savings. In some institutions, those rates for CDs and savings currently have gone astray somewhere. But we all hope that those days will come back, where interest on savings accounts are still 4 and 5%, but interest for CDs are still 7 and 10%, God forbid, or even higher. All right. And then, of course, the final structuring point has to do with financial covenants, which is agreements, the documentation, the signing. Covenants, of course, are agreements, and they should be as detailed as possible. They're there to protect lenders and the borrower. The promissory note, the chattel mortgage, the loan documents that you sign, the mortgage documents, whatever the covenants are. Be sure the bank is thinking about its personal interest first, and maybe to some extent the interest of its customers second. Customers should be concerned with the covenants as well, because those agreements, depending on what happens later on, can come back to haunt the customer if they didn't see some things they were supposed to see and question some things they were supposed to question. Okay? But again, the covenant is what this is all about. It's everything written down for everybody to see, raise questions to see if they're happy with it or not, and to make the necessary adjustments if they can, in fact, be made. And let's not forget that while these covenants are designed for a great deal for the lender, they also act as a buffer for the borrower. Okay, so that the lender cannot just arbitrarily decide to do something contrary to the terms of the agreement. Okay. All right. So that's your loan structuring discussion. And so you can see typically what kinds of questions can come from loan structuring, such an important part of the lending process. And those lenders who treat that part of the process lightly will find that they might end up with greater delinquency along the way and far more problems working loan accounts than they need to have. And if you observe these principles, you pretty much try to work within the guidelines. Of course, there should always be room for flexibility. As you can see, we don't use the word flexibility much, but there are some words in here that suggest that there's room for flexibility, and we have to do that as prudently as we can. All right. So now it's my time to take a break and see who will help us bump along. I think tonight I'll start at the bottom, and there, that would be Delali. Are you still there?
Sir,
Okay, wonderful, Delali. Why don't you begin on page 22 with the credit application part?
okay. My pages are not numbered.
The one you didn't get a copy with the numbers on it from Miguel?
No, I printed the first set, so I didn't reprint it. So it's credit application, right?
Yeah. Mm-hmm.
Okay, so a credit application is a form used by potential borrowers to get approval for credit from lenders. Today, many credit applications are filled out electronically and may be improved in only a short amount of time. Once you fill out an application, the lender will pull a version of your credit report and or credit score. They'll use this credit profile and other factors like your income or your debt to income ratio to determine if you meet their underwriting standards. Credit application form. Whether you're giving out business loans or individual loans, automate your credit application and process your credit application process to approve lines of credit faster with an online credit application form. Simply customize a form template and embed your customized form into your website to start accepting credit application online. Whether you work for a bank or credit union or you're an independent lender, streamline your credit application process with our credit application form. No more time-consuming person visits to approve credit loans. Mortgages, car loans, home loans, small businesses, or corporate loans. No matter what kind of credit you offer, customize your personal or business credit application form to include your unique terms of repayment, update fonts and colors, add your company logo for a personal touch. You can even link your form to a PDF template to automatically generate loan contracts as professional PDF documents. Create a seamless credit application process from beginning to end by starting out with a free custom online credit application form. Credit applications allow lenders report on each account that is established with them. They report the type of account, credit card, auto loans, mortgage, etc. The date you open the account, the credit limit or loan amount, the account balance, your payment history, including whether or not you have made your payments online.
Yes. Keep going, Dr. Lally.
Okay. Credit application process. A credit application is a request for an extension of credit. Credit applications can be done either orally or in written form, usually through an electronic system. Whether done in person or individually, the application must legally contain all pertinent information relating to the cost of the credit for the borrower, including the annual percentage yield and all associated fees.
Before you go on, Lally, does anybody know what cost of credit means? What does that refer to? Cost of credit. Starts with I.
The interest.
Yes, the interest. So anywhere you go in the borrowing world and you hear the expression, the cost of credit, your ears should perk up because we are talking about interest payments. If you are the lender, you always want to maximize your interest. If you are the borrower, you always want to do what?
Minimize.
Minimize. Yeah, if you're the borrower, you're looking to minimize your interest. You want the lowest interest.
Lowest interest rate, yeah.
Yeah, but if you're the lender, you want the what? Highest interest possible. So somewhere between those two things, we negotiate to see if we can come to a reasonable agreement. God forbid. Okay, keep on going, Delali. Sorry, I called you Delilah, not Delilah, Delali.
Not from the Bible, no, Delali.
Yeah, Delali, yes.
Right. The annual percentage yield is the real rate of return earned on a savings deposit or investment, taking into account the effect of compounding interest. Unlike simple interest, compounding interest is calculated periodically, and the amount is immediately added at the balance to the balance. With each period going forward, the account balance gets a little bigger, so the interest paid on the balance gets bigger as well. The following are key points regarding the annual percentage yield. 1, the annual percentage yield is the actual rate of return that will be earned in 1 year if the interest is compounded. 2, compound interest is added periodically to the total invested, increasing the balance. That means each interest payment will be larger based on the higher balance. 3, the more often interest is compounded, the better the return will be.
Now, before the lally goes on, I don't know how many people in this room understand those 3 APY points, but somewhere between myself, if you're not clear, or Google or whatever, those 3 points are very critical things to know, even if you are not a lender. You will always be a borrower in some form or the other. But this thing about simple interest rate and compound interest, they are very important concepts to know. And so if you hear them going forward, you want to be sure that you know the difference between the two. Usually compound interest will result in more interest at the end of the day because it's interest on interest. Simple interest typically ends up with a lesser amount than if you're using the compounding method. Very important things to know just in general as well. Okay, keep going, Delali.
Okay. APY is similar to the annual percentage rate used for loans. The APR reflects the effective percentage that the borrower will pay over a year in interest and fees for the loan. APY and APR are both standardized measures of interest rate expressed as an annualized percentage rate. Credit application processes are increasingly becoming faster and more automated as new technology systems emerge in the credit market. Technology allows lenders to offer borrowers varying types of credit application that can be done either in person or individually. Regulation Z governs the disclosure provided in credit application for borrowers and provides for consistency across all types of loans. Technology also allows borrowers to complete a credit application completely on their own through an online application. Credit card applications are typically processed through an online credit application. Okay. Technology also allows borrowers to complete a credit card application completely on their own through an online application form. Credit card applications are typically processed through an online credit application, often providing the borrower with an immediate approval. Banks and emerging fintech companies have also increased the online lending options available for borrowers. For borrowers who seek more personal interaction, traditional bank lenders offer branches across the nation with customer service representatives available to help borrowers in lending process. Some banks even offer telecommunicating services for discussing loans and completing a loan application over the phone. This type of service is a part of traditional bank model that loan applications over the phone. This type of service is a part of traditional bank models that includes more personal interaction in banking services. Typical loans that borrowers may seek to apply for in person can include bank line of credit, mortgage loans, and home equity loans. In all types of credit applications, the information requested is typically the same. A lending decision will be based on a hard credit inquiry, which provides details on a borrower's credit score and credit history. In addition to credit scoring, lenders also base loan decision on a borrower's debt to income. Mainstream lenders will typically look for a credit score of 650 or higher with a debt to income ratio of 35% or less. Each individual lender, however, will have their own standard of credit writing, and credit approval.
So before you go on, Delali, let me just say something about that last paragraph. Because we talked about credit scores before, with credit bureaus, etc. This is to give you some idea of the range of credit scores that are considered to be acceptable typically. I think I may have shown some scales earlier. Typically under 500 tends to be a problem. Anything from 6 and above tends to be above average. And then anything over 750, 800 means you're way heading towards the great type of credit person that they believe you are to be. And you are judged very seriously on these credit scores. Debt to income, credit scores is just one of the measures when applications are being considered for loans of any kind. Let's not forget debt to income. We may have talked about that before. That simply means, we look at the number of loans you have out there, because some people have like 3, 4, and 5 individual loan payments. And so when you go in for that next loan, the lender is going to look at all your outstanding debt payments and say, wait a minute.
I told you to follow that.
You make $2,000 a month, but your loan payments alone add up to $1,300.
Mhm.
That gives us a debt service ratio of what? Can anybody work that out? Your salary is 2,000 and your loan payments are 1,300. What is the debt to equity to income ratio?
I'm on like 60%.
Yeah, 60%, way above the 35 to 40% that is considered acceptable in the average jurisdiction. Okay, for sure. And so that is a key factor with regards to whether or not a lender will consider giving you a loan at all. Now, some lenders, depending on your situation, your collateral, and your credit history, and all that kinds of stuff, might actually have the heart to consolidate all those debts and say, hey, we want to bring everything into the fold. You have enough collateral, you have equity in your home, you have this, you have that, you have a Lamborghini, whatever the case might be. We'll hold all of that as collateral and we'll consolidate everything, give you one single payment. If that can be done without all the attendant stress, then of course your debt to income ratio will improve. But typically outside of that, if you have that kind of rate, 60%, 70%, whether it's individual, company, or even country, those kinds of ratios are considered too high in terms of borrowing, and lenders are going to be reluctant or they're going to turn you down for sure. Okay. So debt to income, credit scores, these are two very key components that lenders look at in terms of whether they should consider giving you a loan, whether you are an individual, an entity of any kind, or even a country. Okay. All right, keep going, Delali. Regulation Z, a US regulation.
Regulation Z. Regulation Z is legislation that governs the reporting of credit details to borrowers. This legislation was established as a part of the Truth in Lending Act of 1968. It is enforced by the US Federal Reserve Board and the Consumer Financial Protection Bureau. Regulation Z helps to provide consistency across credit disclosures. This consistency is expected to protect borrowers from being misled by creditors, while also helping borrowers to better understand credit terms and more easily compare products across lenders.
Now, students, imagine this, a whole bit of legislation designed to what? Protect borrowers from creditors? Why would that be? You mean creditors are untrustworthy?
Yes, they lie.
Yeah, thank you, Delali. They lie. Whether you believe it or not, they lie oftentimes more than they should. They mislead borrowers oftentimes more than they should. They have a very sincere smile sometimes while they are misleading borrowers, or oftentimes than they should. And if you are a lender, it is not an aspersion on you. Just make sure you're not one of those lenders. But we do have them out there. Just like we have sharks in every other profession, we have them in credit as well. And so Regulation Z, and probably something we need in the Bahamas, perhaps the Caribbean, and other countries. Truth in lending, which means that if the lender does not disclose properly and tries to do anything to mislead the client, the customer under the act, they can sue, they can take action, they can report that lender, and that lender will have to give an account
Why
for.
would you say someone lies?
So say it again, Marissa.
Why would you say a person lies? The reason why I ask that, for example,
Mhm.
I work in the credit card department and we're doing I don't know how many persons buying with Commonwealth Bank, but we're doing the Sun Card decommission where Sun Cards was discontinued on May 31st.
Stop
And
the
the
math. Wait a minute. Marissa, are you
hi,
kidding me? Sun card is being discontinued?
it already has.
So when are you guys gonna tell the rest of the world, some of us who are just catching up and want a
It's
sun
been
card?
on radio, it's been on TV, it's been in the newspaper. Persons.
Okay,
So the credit from the Sun Card, if you only had a Sun Card,
right,
based on your credit limit, we would order you a MasterCard. But
right.
if you have two cards, the Sun Card is discontinued and the credit from the Sun Card is uploaded to the MasterCard. Now, like I call a customer today, she's like, no, I don't want them combined because I can't afford to do this and I can't do. So the only thing I said to her, I said, Mom, nothing is changing. It's just your card. So you're still making the same payment. The interest rate is not changing. You're just getting a new card, but you'll be making one payment instead of two. So is
Right.
that a lie?
No, that's not a lie.
Oh,
No, that's not a lie. As a matter of fact, there's some degree of reasonableness in that as well that you may not see elsewhere. For example, the certain things remain the same. So sometimes when persons make a transfer of that nature, they might try and increase the interest rate and make some other changes to make some money along the way that they probably shouldn't be making of customers. But in your case, where everything has remained the same, you're just transferring it to a new card and not trying to bamboozle the customer in any other way, that is not considered a lie in credit. Okay, so you
well,
find.
some of the stuff will change because some persons even forget what their credit limit are. So when you say to them, well, your Sun Card is such and such amount and your MasterCard is this. So I told a lady today, now your new credit limit will be 14,000. She's like, what? How much my MasterCard was again? So I was confused. So when she say to calculate it, and I calculate the 3% for her, and I said, it will be some 700 and something dollars based on the two brand credits. She was like, oh my God, how did it get like that? And I was like, ma'am, so I don't know.
Well, when she had two cards, the payments between the two would roughly be the same, I imagine.
Yes, but to her, it was a complete shock. Like she didn't know her credit limit is now 14,000. She said she actually forgot that her MasterCard credit limit is actually that high.
Yeah, some people actually forget, and some people act like they actually forgot. And sometimes you can't tell the difference between the two. But there are some people who actually forget what the amount is. And then there are others they remember very clearly and they're like, really? When did that happen? And they remember quite clearly. So yes, unfortunately for everyone, the financial institution assumes that you should know. Like ignorance of the law is no excuse. It's kind of like that. But yeah, you do have those groups who remember for real and those who say they don't remember. And maybe it's for real. But yeah, no, in that case, in your case, that's fine. That's not a problem there at all. But there are other kinds of creditors who twist the information, mislead borrowers, don't tell them everything they need to know, believe it or not. And usually when that happens, it's because the creditor will benefit in some financial way, unfortunately. And then, of course, if they feel that the borrower is not informed enough, they don't understand credit terms well enough, and they don't know how to compare products between institutions and so on, or even within the same institution. Like if you're giving different types of cards, people may not understand why one card is better than the other one, or they may not understand that one card is really not better than the other one. It's all cosmetic. Whatever the case might be, if these things are not clearly explained, then we say it could be a violation of the Truth in Lending Act. Because really, under that act, creditors should disclose everything to borrowers that's important. All right, for sure. And sometimes that does not always happen. A lot of times it does happen. Borrowers just are not listening or even understanding and not saying that they don't understand. So again, the act is there to protect in general, but as usual, there are always gray areas.
Mr. Wilkinson,
Yes.
in that instance, what she's explaining just now, wouldn't those two separate cards have two different terms? So
Yeah,
it can also not be beneficial to the client because, like she said, the person didn't know that her credit limit has increased. Sometimes when your credit limit increase, your interest is also different based on that facility.
correct. And yes,
So she may be forced into a higher interest because her credit limit has increased.
absolutely. And so if Marissa doesn't want to be accused of violating the U.S. Truth in Lending Act, which we don't have in the Bahamas, then that is certainly something to look at in terms of in making the change. Is the client better off or worse off interest-wise in terms of what their ultimate interest rate is? And what do I mean by that? With the Sun card, they may be paying 4%. With the new card, they might be paying another rate of interest, and maybe if they're held separately, they're paying less than when we combine them. That is certainly something to consider.
And her term may be different as well. So it could be detrimental to the client as well. So if they don't understand the facility and they're just thinking I'm having a better, a higher, like she said, it goes up to 14,000, it may not be good.
No, it may not. Or some clients are kind of naive. They're like, yay, one payment instead of two. And they don't really realize that when they're making one, they're paying more in interest than when they were making two payments. Yeah, which is a good point, Joey, because even outside of credit cards, for example, if a customer has two regular consumer loans, for example, one consumer loan might have one rate, the other consumer loan might have another rate, and the lender might say, we may as well combine these for you, consolidate. And the customer say, yippee, one payment. But in effect, at the end of the day, it may not necessarily be in their best interest because at the end of the day, they're paying a greater amount in interest by consolidating. Okay? Because the lender might say, okay, because we're consolidating, the interest rate is going to have to be 14%. And if the client is not really aware of what's going on, they won't know that, oh, okay, one loan was already 6%, and the other, the new loan, the other loan is already, let's say 5%. So that's 11%, which is less than 14%, but I need to keep them separately. And furthermore, the other ones you want to consolidate is already almost paid off. And if I consolidate, then you're going to put that in there for another 7 years. See, customers don't know this stuff. And
yep, and they also get you with the lower payment because
sure,
you have a lower payment, but for how long?
Sure. And for some customers, the lower payment is ideal for them no matter how much interest they have to pay. They just have to suck it up because their cash flow demands that they have that lower payment or dog eat their lunch each month. But again, where it doesn't have to happen, it shouldn't happen. Sometimes it doesn't have to happen, but it does, unfortunately. And this is what we mean by misled by creditors, truth in lending. The borrowers need to better understand credit terms and things, etc. Absolutely, absolutely. Okay. And this stuff is quite real, quite current. There are a lot of borrowers who really don't understand what they're doing. They just want the money. They just want the smaller payment. They just want the one credit card with just make my life easy. I don't care. I don't need to know the details, which oftentimes is not always good for that. Okay, Delali, credit investigation.
Yes, credit investigation. A credit investigation is a procedure undertaken by a financial institution to vet a potential client's ability to pay back a loan. Failure to pass this procedure means disapproval of a loan. It is an appraisal of a prospective borrower's ability and willingness to repay a loan carried out by a credit analyst. The purpose of a credit investigation should be to obtain information to make a specific decision about granting credit. The goal of the investigation is to obtain factual and accurate information that will lead to an appropriate credit decision. When the application process is completed, immediately have the client or customer sign the application form and request the basic requirement. Example, salary, income documents, financial statements, bank statements, or other business paper. Then, while waiting for the requirements, start the credit investigation process. Personal data verification. Have the client and his place of residence be investigated by a third-party credit investigator. Check the validity of the information that the client provided in the application form.
Why are we checking the validity, anyone? Why are we checking it? Why don't we believe the client?
Because we need to be able to find them in the event that they are not paying the loan.
Yeah, and also clients don't always tell the truth, so we have to go back. Sometimes folks bring a job letter, for example, and they stamp it themselves with some stamp from somewhere and make it doctor it on the computer and say HR department. If you don't call back to verify, then you would never know. Okay, so this data verification is very serious because clients are sometimes just as shrewd as lenders but from the other side of the fence. See my point? All right, keep going.
Okay, credit bureau. Check the existing bank loans of the clients through banks and credit bureaus to determine if he or she is overly leveraged. Negative findings with previous loan, current accounts, credit cards, and court cases can also be viewed from the negative file information system. This report will determine the character of the client. Bank checking. It is important to check and verify the existence of bank deposits of the borrower with other banks. In this way, you'll be able to determine his or her cash flow and what type of depositor he or she is. Business verification. To be qualified for a commercial loan, one must have a source of income or business. You need to know the kind of business you're going to finance and its capacity to operate for a long term to ensure that the money that will be lent will be repaid. You also need to know the legality of business by verifying it with TDI if sole proprietorship, or with SEC if partnership or corporation. Trade verification. Another way of determining the character of the borrower and the stability of the business is through trade verification. Interview with the customers and suppliers is important to know the average volume of client's business and what kind of payer he or she is. Employment verification. This applies to clients who are also employed. It is important to check your client's employment income, as this will further strengthen his or her ability to repay the loan. Rental verification. For a client with leasing business, the rental income and existence of tenants must be verified, since this is also a source of repayment. Court case verification. If a client has a court case found in the negative data, its extent and status must be verified with the concerned regional trial courts. If the case is criminal or still unsettled, then decision must be immediately be made if you will still pursue the credit application process or not. The type of character of the client is reflected on this report.
Thank you very much, Delali, for all of that stuff and for dragging us through this crazy part of the lending process, which is the credit application process. So we can get to see all the bits and pieces that are involved in whatever type of loan that you're doing. Again, Every organization's policy will be different depending on the type of lending they do, because every organization has its own combination or custom type of loans, and so their processes will vary. But the principles that we're talking about here will hardly vary. Okay, so no matter what type of loans you're doing, even if you're giving a loan to a family member at home, a lot of these principles apply still. I mean, you may not want to drag them across the ground, or maybe for some you might, but the principles hardly change despite the type of loan. Okay, Regulation Z is an interesting concept. Maybe we'll have such a regulation in this part of the world eventually, but it would be very helpful for all concerned, in particular the consumers or the borrowers in this case, because a lot of them are still being taken to the cleaners, unfortunately, not by all lenders, but we always have something going on with somebody who's seeking to get the better of somebody, right? Unfortunately. And I need not say that all the verification lists, items listed, I think we've gathered by now, just based on her reading, that these things and more, when necessary, need to be checked. You ask for documentation, that's good. You want them on file, but all too often, depending on the nature of the loan, the amount of the loan, and the type of facility and what you're doing, you definitely want to go back and do some checking of the information that you're given. Okay? It's like when you're dating, you ask somebody if they, excuse me, before we start dating, can you just answer one question? It's like, sure. Are you a psycho or not? It's, come on, do I look like a psycho? And then you say, well, maybe not. And then when they leave, you go onto Google and see if you can find out if it's true or not. Kind of like that, verification. Because if you don't do key verifications, and these are just some of the key ones, there may be others that you may want to conduct. For example, if you're giving a loan against shares, you may want to check with the securities market people to see what the values of those shares are, whether the information they gave you with regards to the shareholdings are correct. Call a broker somewhere at Fidelity or some other broker in the international market to verify whether those shares actually exist, whether the characteristics of those shares are real, and whether the market value of those shares are realistic. See? So all of a sudden, and then in many cases, if you're giving loans against shares, you don't do 100% lending because share values go up and down. They're very volatile depending on the shares that you're dealing with. So if the share value in the market is $100,000, typically lenders might say, great, we'll lend you 50% of that. So we won't lend you 100,000, but we'll lend you $50,000 because the share values are not solidified. They can change, and they can change quickly. And we don't want to expose ourselves by giving you 100% financing against the current market value. And then, of course, in 3 months, the market value changes. And that, of course, could be for the worse. Could be for the better, but could be for the worse. So if you're a lender, verify, verify, verify. If you're not a lender and somebody tells you something and you need to check it because it's important, same principle applies. All right. I have a typical loan application here. Some applications are much longer than this one. Some applications are even shorter than this one, and some are far too long. And some perhaps need to be long because of the nature of the covenants, the type of loan, the amount of money involved. And so every detail has to be outlined in the covenants to make sure that there are no loopholes for lawyers or anyone else later. Okay? But this one on page 26 and 27 is a typical application, starting off with the personal information of the borrower, the employment information. If it's a company, company information will be, so the application will be slightly different. If somebody's signing on with you as a co-applicant, then if you get all the information on the co-applicant, beginning with their name, collateral, where they live, where they work, the whole 9 yards. And then the employment information on the co-applicant as well, or guarantor. So co-applicant or guarantor. All right. So you can see, even though it's only 2 pages, it's quite detailed, asking for a lot of stuff. credit card details, employment details. If you have a mortgage details. If you have a car loan details, any other debts, credit cards, etc. All those details have to be included. Because at the end of the day, the lender wants to see the entire financial history. It's like doing blood work at the hospital. We take some blood, and then we conduct all kinds of tests to see if everything is okay or not. Lenders with their applications is like taking blood, which is why confidentiality is so important if you are a lender, because you are taking blood. You are getting sight of people's very personal information. It's almost like when you go to the hospital and you say, take off your clothes. Oh my God. Take off my, do I have to take everything off? Yes. Oh God, where's the blanket thing? Okay, so it's kind of, for some people, giving you all of their financial information is kind of like that. And so it is absolutely critical that we treat the information that we get from clients, no matter what capacity or type of lender or otherwise, that we might be, with the greatest amount of confidentiality, and that works well for everyone. Okay? All right. So this credit application then that we see with all this information, all this verification, all this structuring and all this kind of stuff, as you can see, all of these different aspects of credit at the end of the day are designed to come together for one single thing to happen. And that is for the lenders to say to be or not to be. But before we can say that, all of these things typically has to happen, which is an amazing phenomenon. And for any lender who decides they will take shortcuts because they don't want to go through these processes, will find themselves wanting. And as a matter of fact, the more money that you're seeking to lend and the purpose that you're lending it for, and the term that you're lending it for. In other words, if the purpose is critical and the amount is huge and the term is long, you need to spend even more time with these things that we're talking about. And so now, after all of that, we come to this, the credit evaluation. And what is that? That is taking the application and all that other stuff we discussed and trying to come to a decision. And that process is what we refer to as the credit evaluation. And what do we do during this process? We evaluate the credit worthiness of this customer. Okay? Not a simple matter, because trying to determine credit worthiness is a huge challenge depending on the customer. If your customer is an individual, it's a huge challenge. If they're a company or entity, it's even bigger challenge. If it's a country, a whole other set of challenges in trying to evaluate the credit. Anywhere from, is this salary slip correct, to, is this information from this country's treasury on its debt to income ratio correct? Okay. And so these are the things that we refer to as the elements of the credit evaluation process. How does the bank minimize its risk exposure? Is the company protecting its profit margins? Is the company maximizing its margins? Has this person been working for a year or 10 years or 20 years? Okay, all part of the evaluation process. So you're trying to look at all the information you gathered and verified and say, okay, doggone it, what do I do now with all this stuff? Well, one of the things I mentioned right away is that one of the first things we should do when we're looking at credit evaluation and managing credit is to what we call make informed decisions. Okay? In other words, don't make any decisions based on what anybody tells you, what they feel, what you saw on TV, a dream you had. None of that stuff. Your decision should be informed, means that should be based on information gathered and verified. Okay? That's what we mean by informed decisions. Fill out the application completely, not halfway, not haphazardly, not because I've had a long, I'm sick and tired of filling an application. You can cause those things to cause you not to be complete. Because if you do any of that stuff, your evaluation process will suffer. Informed decisions. All right. Now, nobody likes turning down a loan. Credit people love to give loans normally. Some credit people love to decline loans. But borrowers definitely don't want to hear no. And sometimes we have to tell them no. That's just part of the deal. The thing about telling a client no is that you should give them a reason. Now, some people might say, well, you didn't meet the company's policy, and that might be true. This loan is too expensive for you, can't afford it. The amount you need to borrow is too much, you can't afford this loan. Whatever the reason is, the lender should tell the borrower, don't just say your loan has been declined, please leave the building. They should be given a reason. We have this thing in the job market where people are hired on probation, for example, and then under the terms of the probation, their employers, which are equivalent to lenders in this case, are happy to say in the letter that under the terms of the probation, we can dismiss you at any time without an explanation. And to make the employee happy, I guess, there's another clause that says, and feel free to leave anytime you wish without an explanation, as if that satisfies the employer's responsibility to just let you go without any explanation. Okay. But that kind of at-will employment, probationary type of employment is very common in many organizations. And like some lenders who abuse their power, some employers abuse their power as well and dismiss people without any reason because they don't have to. If they don't like your hairstyle, they'll say, well, you're not a good fit. If you don't bow down and worship somebody, they say, oh, you're not a good fit, because they don't have to give a reason. It's kind of like the credit person saying, well, your loan has been declined. And the client says, well, why? They say, we don't have to give you a reason, Mrs. Smith. It's been declined. Go to Royal Bank. And better still, go to the mortgage cop. See what they can do. That should never happen. Okay? The customer is entitled to know why. It doesn't meet the policy, and here's why. You have too many loans outstanding, and we cannot consolidate at this time. Keep paying them down as best as you could until you get to this point. And when you get to this point, then maybe we can look at a consolidation for you. Come back in 6 months, Mrs. Smith, and we'll evaluate your situation again. Okay? That's how the evaluation process should work. That's how the loan decline should work. That's what being a professional lender is all about. Speaking about this probationary thing, the reason why I raised it again, because it's very similar to the situation where the lender doesn't want to give any information or reason. I had a client not too long ago came to me and said, is it fair that when I'm on probation, they could just let me go without a reason? I said, of course it's not fair. But unfortunately, the law somehow, to some extent, provides for this. And I personally don't agree with it. I don't think any employee should dismiss somebody without having to give a reason, because that leads to people being dismissed wrongly, willfully, and God forbid, for whatever reason, oftentimes not necessarily proper or legal or moral. Okay. But let's ask the attorney in the room. Lisa, are you here? There?
I'm sorry, what's the question?
Lisa, the question for the attorney in our room. Should employers be allowed under the probationary clause to dismiss persons without an explanation?
Yes,
And your reason?
because that is your probation, that is your period where you're gonna evaluate the person to see if they're a right fit for your organization.
Well, how would they know if they fit? If you never give them a reason.
Well, you don't have to give them a reason in the probationary period. That's the point. That's the point of the law, to give the employer that leeway to decide in that moment.
How will the employer know whether they're meeting that fit or not?
Well,
Mhm.
most banks have people in position who are supervisors and human resources managers, and they have evaluations and all those sorts of things that they have in place to
Oh.
to ascertain whether the person is, one, qualified, and two, whether the person is a right part for that team or that department.
In other words, what you're alluding to then, Lisa, is that when the person comes on, if
Mhm.
they are violating any issues that, whatever it might be, that there should be a supervisor to say, that's not what we require, this is the correct thing, do not do it again.
Yes,
Okay, and so there should be a what? A trail.
there should be a trail.
Yeah.
Now, granted that the catch-all phrase is without cause, because without cause means I can hire you, and in the 3-month probationary period, I can say, or whatever period that the company have, I can say, I no longer need your services and not give a reason.
Should you
Most
be
of the times, most times there are reasons, but I find most employers are wimps, or their managers are wimps, and is not willing to tell the employee what the situation is.
Not only that, not only are they wimps, but oftentimes they're like those lenders that we talked about earlier that are not honest in their behavior towards borrowers. In other words, people have personal vendettas against people.
Agreed.
And therefore, for example, if you don't get involved with their politics, if you don't make their coffee, if you don't bow down and worship them when they walk into the room, or whatever it is people get off on, then they simply say you're not a good fit.
Well, that's true.
Because they don't have to give a written trail to show that they actually try to make the person suitable for the job. And most of us are unsuitable for any job in 3 months. True or false?
False.
Most of us are unsuitable for any job in 3 months.
False.
No matter who we are. Why don't you agree with that, Lisa?
I think it's adapting to systems. A trained physician can go to another hospital and adapt to their system in 3 months. I think it depends.
I remember
a trained attorney can go to a law firm. Even for the most part, most juniors can go and adapt. It's the environment. It's the back foliage, like you said. Who doesn't want to make the coffee or adapt to certain person's personalities or bow down? Those are the. I think even when I worked to Wendy's, it was sort of a similar thing. The environment.
Yeah.
It's the environment you work in. You come in with no training, but you're gonna be trained. Right. But for most part, in environments like that, you lose a lot of people because of the personalities, not the work.
And not only in Wendy's, you're a very sophisticated firm who take on even first-time persons, newbies coming on the job, people right out of college, people who have not worked in that industry before, and well capable of being trained, but because of the personal issues, they get booted by Tingham and Tingham them, as we say. It's the most unfortunate situation. And one of the other problems with that is, I've found, and I'm just throwing this up because all of you guys are employees and may find yourselves, whether it's a financial institution or elsewhere, a lot of times people would move from confirmed employment. They've been somewhere for 5 years, and then they're going to a new job. And the new job says you're on probation. And if somebody in that job doesn't like you, in 3 months or less, you're out of a job.
True.
So who mitigates that risk?
There is no you take the chance of accepting the job.
Should you have to take the chance?
You applied, right?
No, I know. But what I'm saying is the law should require that if when a person comes, you have a process in place if they're not meeting the standard, you have the documentation to show they're not. You cannot just arbitrarily say it by word of mouth. That's not good enough.
You mean within the 3-month probationary period?
Of course.
But that's why they gave you that catch-all in the probationary period, so that you do not have to, because at that 3 months and 1 day, then the employer is liable.
I know. All I'm saying is the same way we have Regulation Z to protect consumers, we need a law that says get rid of probation. They're either going to be an acceptable employee or not, period. No probation. You hire them. If they're good,
I disagree.
I know, because we are so accustomed to that convenient thing called probation. This is just I understand. I'm just saying, just like Regulation Z, we need a Regulation X to get rid of probation and deal with people as they are. If they're suitable, keep them. If they're not, write them out or fire them.
Yes, but then you okay. We're talking. You're talking about some expensive writing them out.
Well, so what? Somebody has to take. Shouldn't Goliath take the greater risk than David?
No.
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 Okay, so the employer still gets the last laugh.
So the employee, you can leave too.
I know, but we all know it's not the same, Lisa.
Well, life isn't fair.
But it could be changed. Remember Regulation Z. All right. Thank you very much for that bit of feedback, Lisa. That was just for the benefit of your colleagues as well. Something for them to think about while they're thinking about Regulation Z. How about that? All right. So the application, we've seen it. And so this list of information to do on the application is pretty much what we've seen on the application. For example, contact information, credit information, contact the landlord or the mortgage holder if there's a mortgage, contact the bank if there's banking information to be checked. If it's a company trading with another company, check the creditors, the suppliers to see whether the company is a good paying company. All these things are absolutely crucial depending on the type of credit that you're considering, and shortcuts in credit will always bring you the results that you do not desire. Okay. Payment terms should be clearly stated on the application. If there's a co-application or guarantor, that person should be signing on or signing the guarantor's application so that all the relevant information is in place with regards to that particular credit. Avoiding or ignoring any of these things will ultimately hurt the lender, and maybe, depending on what is omitted in some cases, even the borrower. Okay? I noticed the point I made on page 29 very explicitly. Nobody extends credit to a company that they think won't pay. That's interesting. Now remember, we're not talking about if you know somebody and that's your boy and you all went to Kingdom School, that's my church member. I'm not talking about those personal things that cause us to violate the normal things. I'm just talking about the normal things. Okay? So typically nobody will extend credit to a company or individual that they think won't pay. So that means then that somewhere along the way, we have to satisfy the person who's lending, even in a personal loan between individuals or family members. Some of us are family members will never lend money to because we know they're not going to pay. They have a history. Then there are other family members that we don't have any problem lending them money because we know if they say next week is next week. And it's that way outside in the real world as well. So oftentimes, though, what do lenders do? It's okay. This person is not a very strong applicant. They've only been working a year. They don't have any real collateral. They do have some savings to put into the down payment. They want to buy a car. They need to get to work, whatever the case may be. And they say, hey, do you have somebody who will guarantee this? And they say, yeah, my dad, my mom, or whomever it's going to be, And so that then strengthens the application, and the lender might decide to go with it. Sometimes when the person brings a guarantor or the guarantee, sometimes the guarantee is equally as weak. They bring their sister or brother and say, excuse me, they've been working less than you. You can't take this person. All right. So again, it's all very relevant to the situation. And so what do we say we're doing when we're doing this evaluation? We say that we're analyzing this whole bunch of information that we get from all and sundry, and somewhere along the way, what are we trying to do? We're trying to get to a point where we can take all this information and help us simply to say yes or no. Interesting, the amount of information that we require to say yes or no. Do we always require all this information? For the most part, unfortunately, the answer is yes. Do we always have to have everything up front before we make a decision? The answer is no. Even though some lenders insist on bringing, you bring everything first and then they tell you no, rather than use a certain other technique like look at the key things, and if the key things are okay, then you say, fine, we have an approval in principle subject to yes meeting the other documentation and other requirements. Okay. Again, all different types of lending techniques. And again, it all depends on the individual. Just like the probation thing that Lisa and I were talking about. You get a certain type of supervisor, man, they will help you, they'll work with you. If you make a mistake, they'll show you because they remember when they didn't know, they remember when they started a new job, and blah, blah, blah. And unless you do something really out of the way or really abuse the system, they're going to confirm you. Then you have other people, they enjoy not confirming people unless it's somebody that they choose to confirm for their own personal reasons. Okay? And sometimes, unfortunately, credit has some interesting twists that way. Should it be that way? Of course not. But like everything else, these things are there. Okay, for better, like Lisa said, for better or for worse. All right. So just know, for those of you who are in this room, that if you are on a secure job and somebody says, we'd like you to come and work for us, but you have to go on a 3-month probation, just know that you are taking a risk. And that's okay if you're prepared to take that risk. Okay? By all means. All right.
Mr. Wilkinson,
Yes.
I don't want to be mischievous, but I'm just putting
I
a
want
hint.
you to be mischievous.
We are
I was hoping a devil's advocate would show up. Let it rip.
I'm saying I just want to put a hint out there that we are halfway through.
We're halfway through already.
Yes, we are.
You mean halfway through our class?
The booklet, yes.
Kiss my foot. When did that happen? Okay, thank you. There's nothing mischievous about that. That's fine. Okay. So now we think that by the time we get to page 29, isn't that enough? For some lenders it might be, but typically there's more. And what do we mean by more? I don't know if anybody in this class has ever heard about the 5 C's of credit. Anyone? No? Wow.
Yeah,
Who heard about the 5 C's?
I did.
Okay. Walter, yes. Walter, where did you hear about the 5 C's of credit?
My work.
Okay, so that's in your lending capacity.
Yes.
Absolutely, absolutely. So for the rest of your colleagues, this is going to be something novel then. Okay. But for Walter, it's not novel. And the 5 C's of credit is represents in lending what we call some of the building blocks. Okay. And the reason why we call them building blocks, because again, seasoned lenders and not so seasoned lenders would always want to consider these 5 Cs with any credit application to see if the applicant meets the criteria for these 5 Cs. And you'll see right away why it's such a big deal. Okay. Now, some lenders use the C's differently because we're all different. Some consider the qualitative side versus what we call the quantitative side, the credit history versus the income and the debt ratio, etc. And so different lenders have different perspectives. Those lenders who are into numbers, into the ratios, and those persons who are into the qualitative side of things, the soft side of things, the repayment side of things, the character side of things of the person, and so on. They tend to be considered the qualitative persons, and so again, and then sometimes we have a hybrid where we have lenders who actually consider both sides, which is really the ideal position. Okay? All right, we are told, interestingly enough, that out of the 5 Cs of credit, historically and typically, lenders tend to place the greatest amount of weight on capacity. I wonder why. Okay. Well, capacity, in short, is simply the borrower's ability to pay. And everything after that is about what creates the ability for the borrower to pay. So as a lender, whenever you hear capacity, the first thing that should come to your mind is, this is the borrower's ability to pay. Can this borrower pay the loan? Are they making enough salary? Is their debt sufficiently less that they can afford an extra payment? If they're a company, are they generating enough sales in order to pay this debt off over the next 5 to 7 years? Where is this company in the market? Are they going to likely survive COVID and pay us? Whatever the case might be. Capacity has to do with the ability to pay. For individuals, as I said, it's about their income. For companies, it's about their business, their clientele, how well they are doing, what their sales position is, etc. Okay? Again, the other aspect for individuals other than income is the employment. How long have you been working? If you've been working for a very short time, lenders are a little edgy on that. If you've been working for a reasonable time or a long time, lenders are much more comfortable lending money to persons who have been employed a minimum of 3 years. Okay? And beyond. And certainly the longer you're employed, the greater capacity you believe to have. And what does capacity mean? Our ability to pay. Okay? That's the deal. So capacity is considered the key C of all the C's. Part of capacity is when somebody comes in to get a mortgage, for example. Do you have the down payment? Or for a car, do you have the down payment? Or for property, do you have the down payment? That could be considered part of capacity. But that's more under the second C, which is capital. The first C still goes back to, do you earn enough money, enough debts, or not enough that will cripple your ability to repay this loan? Is your company or your country solid enough to pay us this money that you're borrowing over the term of the loan that we agreed? Okay? That C is the C of capacity, and that's the one that lenders always keep to the forefront, always, always. Okay? The other C is the C of capital. Do you have any savings? Do you have any money in the bank? Do you have a down payment? Can you put anything into this loan? Lenders do not like to give loans to persons who cannot put something into the loan as a down payment, because it is generally felt that if you don't put anything else, you tend to treat the loan a little more shabbily than if you save money and then you have to put a considerable amount of your savings into the debt. That way, you tend generally, lenders believe, to take the debt more seriously. As usual, it doesn't apply to everyone, okay? But typically, they love you to put something in from your savings, from your investment, so that you can be committed, quote unquote, to the debt. Okay? So if it took you 5 years to save $5,000 for that new car or piece of property that you want, and the down payment is $4,500, and you have to go and write a check and give it to the lender as a down payment. When the month comes, month end rolls around, You typically, if you are the typical lender, will seek to pay the hell out of that loan because you've already made a huge sacrifice and taking all of your savings at that point and putting it into this bloody facility, so to speak. Okay? Capital. What can you put in? What do you have saved? Do you have any backup? After you put in your down payment, do you have anything left? Or do you have to start from scratch again? These are all things that typical lenders will consider. The third C is the C of conditions. What is the C of conditions? Well, it has to do with two things. It has to do with economic conditions under which you're getting the loan. That has to do with the term of the loan itself. Should the loan be short, medium, or long term? And what is the economic environment? Is COVID still going on? Can we take a risk to give credit at this time? Are things easing up enough for people back to work enough? And again, even in a non-COVID environment, these economic conditions are still considered because if, for example, the lender feels that the economy is going to run into some trouble because of what's happening internationally, then they might be a little more restrictive in their lending. They may not lend as much. They may not lend as much money. They may not lend it for a longer term. All of these things are what we call the conditions, okay? Whether it's an individual or company. Okay? Companies tend to come in to get financing for overdrafts and working capital and equipment and all that stuff, clearly for hundreds and thousands and millions of dollars, depending on the size of the company. Clearly, a lender is looking at those kinds of things in the face, but want to look not only at the term of the loan, but also the conditions in the economy to see if the present moment is a good time. Question? Okay. Now, we are told that the C of conditions is the most subjective of all the C's. Capacity, the most important. Conditions, the most subjective. And the reason why we say it, does anybody know, why do you think we say it's the most subjective? Why do you think that might be? Anyone? Make a guess. Why do you think it's most subjective? More subjective than the rest?
Is it because condition determines how the loan is going to be paid?
Yeah, conditions determine it, and conditions are oftentimes unpredictable. Absolutely. And it is this unpredictable in the economy, local and international combined, that makes it the most subjective. In other words, you don't have any quantitative data necessarily that you can rely on because the market might be up today and down tomorrow. War might break out in Ukraine, as we can see, to affect conditions. So that's what we mean by subjective. You cannot predict it in any clear way. Now, some lenders, and that's the qualitative side of the conditions. Some lenders do consider certain quantitative measurements as part of the conditions, which has to do with controlling the amount of the loan interest they're going to charge, the amount of principal they'll lend, and how long they will lend it for. These are quantitative sides of the conditions that we can manage, we can control them. But certainly the other side, whether a war will break out, whether the stock market will crash, what any of these things, we cannot predict them. And so that is the subjective side of lending. COVID is the C of conditions. And we've all seen what COVID has done to the credit world. Okay? For many, many people. People have lost their homes in the Bahamas and around the world. People have lost their jobs. Some people have had to start new careers because their jobs are not coming back ever again. The job is not hiring them anymore because they're downsizing. They said, thank God for COVID. We can get rid of all the 50 and over people, whatever the case might be. Those conditions could hardly have been predicted, and therefore they fall under the C of conditions, and it's always a nightmare for lenders when these conditions occur. Same as the housing market in 2007, 2008. Everything was booming before everything crashed. Nobody could have quote unquote predicted it. And so many loans went completely to the dogs. And so much was lost in terms of people's homes, loan facilities that went completely off, millions and millions and millions of dollars written off as a
Can I
result.
ask a question?
Yes.
Why?
Why?
Because I was having a conversation with one of my friends in Canada, and the same thing is about to happen in Canada.
Kiss my foot. What's going to happen? My baby's there. What's going to happen?
They're having a housing shortage, but people apparently are overbidding for properties.
Yes.
And a year or two later, they're defaulting on their loans because they're overbidding.
Yes. And thank you for actually bringing that up, Lisa, because see, that's similar to the same crap that happened in 2007, 2008, when the housing market crashed because lenders were giving loans to millions of people who did not really qualify for those loans. Then they were selling those loans to investors who were packaging them as collateralized mortgages and selling them as investments to persons in the securities market. And so when the housing market overheated, similar to what you're talking about, and everything came crashing down, the whole world, pretty much to some extent, Bahamas included, went into a recession for several years. Okay, so yes, I don't know what the Canadians are planning to do about that to try and stave that off. But if they're seeing that beginning to happen, the government needs to come in and do something to try to curtail that, because if that gets out of hand, then they can, I don't know, I wouldn't say the crash would be as serious as the one in the United States, um, depending on how far they're going to go with this overextension. But in any event, there will be much suffering if they don't find a way to curtail that, and that explodes, unfortunately. Okay? Funny, we don't learn
It's
much.
going to explode.
Sorry?
I think it's going to explode.
Yeah, unfortunately.
Between the realtors and the bankers, yes.
Yes, same thing in 2007. We still don't learn from our mistakes for some reason. And the culprit is always money. A few people getting richer and the rest of the world suffering. Unfortunately, yes. All right. So yeah, that's an interesting point, Lisa, and I hope it doesn't happen, but based on the history of mankind, it probably will. A couple of people will run off, walk away filthy rich again. The economy and poorer people will suffer until the thing settles one more time. Then we go back to business as usual until the next bloody time. Strange. Interesting. All right. Character number 4. Sorry, C number 4 is the C of character. Of course, character has to do with the individual person, the borrower's reputation, the record for paying their loans on time, the records for cooperating with the lender if there's a problem, but more particularly, the reputation for paying on time. Okay, this C character, C of character, has to do with the honesty and reliability of the client, and falls in both qualitative and quantitative. If they say they're coming in at 2 o'clock, they come in at 2. If they say they're going to pay on the due date, they pay, and all this kind of stuff. And even conditions oftentimes do not affect how these people with character and who are honest and who are reliable in their commitment to their loans. Uh, Whenever they establish this kind of reputation, lenders are often more than willing to assist them, even in difficult times. Okay? As opposed to persons whose characters are not so good, they don't have a good reputation for repayment, they don't have a good reputation for being reliable and honest and communicating with the lender, etc. Okay? There's some, like some lenders, some borrowers are up to no good as well. And they don't always disclose, they don't always say, and they oftentimes, sometimes lie about their circumstances, their income, and a whole bunch of other things along the way. Okay, character. Again, the C of character is generally subjective because it involves stuff about the individual and how they behave, whether they're a company or an individual. Companies have character. Some companies are known to be reputable, and other companies are known to be what we call in the Bahamas crooked. Okay, but that's not that's everywhere in the world. But this, if you're a borrower with a character that expounds a good reputation in the credit world, wherever you are, whether you're a janitor or a major company or even a government, that reputation will serve you more times than not, for sure. And the final C, we know that's the C of collateral. We know what collateral is now.
Security.
Yeah, security. And clearly, it's there for the bank to have something to fall back on in the event the customer is not exercising any of the other C's for whatever reason. The bank and then the lender can then say, give me the collateral. If you don't give it to me, I'll have to take it. I'll have to repossess it. I'll have to bring the police to get it if you don't want to let it go, and so on. Whatever it takes to get it back, to sell it in order to pay off the debt, is what collateral serves. If the borrower does not want to fall into that predicament, they should just repay the loan as agreed. And of course, if you run into difficulty, you get sick, you lose your job, all is not lost. When I was a young lender a million years ago, I tell customers at every loan closing, some listen, some don't, but we should tell them, and even tell our people in delinquency, when you call clients, encourage clients to come in. Sometimes we can't treat them like a certain way, otherwise they'll be afraid to come in or too angry to come in or some such thing. And it makes it very difficult to rehabilitate their situation. Okay? But the key is oftentimes to try to get the customer to come in and to talk to the bank, talk to the lender, and come up with some agreement. You lost your job, fine. We'll make an agreement, just as we did in COVID, to help you until you get another job. But when you get another job, don't wait 3 months before you tell us you have another job so you don't have to make the payment. That's a character issue. And if the lender discovers that, they're going to be pretty pissed with you. They're going to make a note on your file. And if you lose your job again, they're not going to be as cooperative. See my point? That kind of stuff. Okay? And this is what we call borrower education. Of course, some borrowers can be educated like some lenders, and some borrowers can, no matter how you try to educate them, they still try to run some program. Okay? But the important thing is to know that these options exist. Okay? Now, again, the loan evaluation process starts with the 5 C's, but it doesn't end there. Okay? Because once we consider the C's of credit, then we now have to get into what we call the analysis side of things. And the analysis really just takes into account all the information from the C's and that we've gathered previously. Again, this information, as you can see, information abounds in the credit world. And the best credit decisions, unfortunately, are those that are based on reliable, sufficient information. Because without reliable, sufficient information, you cannot do a proper analysis, either from a qualitative, quantitative, or any other perspective. You cannot determine the ability to pay for the customer to fulfill their obligations. The only way you can do that is through analyzing the credit information. It's as simple as that. There's no magic wand. Notice right on page 832, I have 3 distinct points. Credit analysis used by creditors determine ability to pay. To determine an individual's ability to pay. To determine a corporation's financial stability, which results in their ability to pay. See? That's the basis of the credit analysis. And we take all this information, C's, verifications, valuations, credit applications, everything, in order to properly evaluate and analyze the situation. So we look at all the C's and the payment history and the amount borrowed and owed and how long the credit existed and what kind of credit it was. Was it a single type of credit or a mixed type of credit? Was it new or old? All these things have to be considered. Again, believe it or not, just to say yes or no. But in essence, it's not just yes or no, because remember, every time we give credit, we are lending the depositors money.
Money.
Yes. And who are the depositors? Us. We are the depositors. And so when that bank or that lender, whomever that lender might be, is shaking hands and giving credit, there is no room for shortcuts because they're lending our money. As simple as that. And they have a responsibility to get it back. For the most part, this is done fairly successfully, but sometimes there are significant losses as well because some lenders make very poor credit decisions, whether on an individual basis, a company basis, and even on a countrywide basis. The countrywide thing is a whole other type of loan situation because, again, depending on the country, the population, the conditions of the people, the capacity of the company, the country, the GDP of the country, the poverty level of the country. See, again, these are all evaluations tidbits that have to be considered by the IMF and the World Bank and whoever else gives international loans to these countries. But as you can see, the principles of lending are pretty much the same as what we're talking about, only on a larger scale, but of course, with some subtle socio-geopolitical differences, quote unquote. Okay? But doesn't change the basic concept that we're talking about in gathering all this information and then analyzing the information and then making a decision. Okay? The world of credit. And we're just touching the tip of the iceberg in some instances, despite all that we've done so far. That's how dynamic credit is. Do you ever become perfect at this? The answer is no. You keep evolving. Now, if you did one type of credit in your entire lifetime, you might come to what appears to be perfect in it, because you spend your whole life just doing car loans, for example, or payday loans or something. And so, yeah, you become pretty proficient at that. But the general concept of it is, man, you're ever learning, ever evolving, ever changing, ever making adjustments, ever looking at new conditions, ever dealing with unexpected situations in the world of credit. Okay? So there's no room to say, I've arrived. Not in this business, for sure. All right. So let's see who's going to take us down the road. Nigel McKenzie, are you still there? Nigel McKenzie. There's an old saying that guys like to wander off. Does that apply to Nigel? You can't find Nigel McKenzie. Okay. I guess Nigel will come back soon, breathing heavily, saying he had something to deal with. Okay, Philip, are you there, Philip? Philip was going off with Nigel. Philip,
Oh, God.
Philip has gone off with Nigel somewhere. So, that leaves the only where have all the guys gone? That leaves the only guy left now in the room. Guys, sorry, guys are pretending to wander off for some reason. Just normally, you guys go anywhere. As soon as you're looking at it, they wandered off somewhere. You take a little boy somewhere, say he wandered off somewhere. Where's Tom? He's gone off somewhere. Okay, that must be a characteristic. Okay, Walter, that leaves you. Are you there, Walter? Walter. Blake.
Hello.
There you are. Okay, Walter.
Yes, sir.
Can you pinch hit for Nigel and Philip? None of them are in the room at the moment. That leaves you the only other guy left.
You want me to do what?
I want you to go to page 35 and just pick up that reading for the checklist for loan processing.
Your Honor, I beg to decline.
Sorry?
I beg to decline.
You decline? The only guy that's left decline? Okay. Well, like when I asked Lisa about the probation, she said, I think it's okay. And I said, why do you decline, Walter?
I don't have my glasses with me, unfortunately.
Well, you know what? Lucky for you, Walter, I get it completely. Because the glasses I have on, they don't hardly work well either. Okay, so if it's any consolation, I'm getting ready to change them. I get it completely. Okay, no problem. Point well taken. Because
I guess my
Huh?
colleague can attest to my condition.
and so can I. If it were me and I didn't have my glasses, I'd have to do the exact same thing because I wouldn't be able to see a bloody thing for sure. All right, not a problem. Okay, so let's see if we can get somebody to pinch it for all the guys then. Okay. Lisa, I've already harassed Lisa with that doggone thing. Who else can
Tonic did a good job last week.
Who did a good job?
Tonic.
Tonique, you have been nominated. Are you there?
Walter, you're too far away.
Yeah, and Walter actually remembers your name, so you know.
Wow.
Oh yes.
And notice he didn't say the
lady from last week.
Yeah, the lady from last week whose last name ends with M. He didn't say that. He said Tonique. Okay, Tonique, so you've been nominated. You have the floor. Checklist for loan processing.
I thought you were saying we were stopping right there to the half mile.
I said no such thing. I said we're gonna keep going until we stop. And
There's a lot of information to process for Wednesday.
Well, it wasn't really for Wednesday. It was like from 2 weeks ago and the holiday weekend and the days in between.
My brain can't take it.
We're on page 33?
Are we on page 33?
Yes.
No, we're on page 35.
Really?
Loan processing, step by step.
Okay. Loan processing step-by-step procedures. Subheading checklist for loan processing department. 1, the loan file. The loan file is where it all begins, depending on whether you are the loan processor of a larger company or both the loan officer and loan processor of a smaller office. The work of the loan processor starts here with this file, well folder. The loan file will contain, you guessed it, the loan application. In addition, it will include comments made by anyone who has had their input in the loan application process, as well as any notes about the potential borrower that was made during the loan interview. Just give me 1 second.
Mm-hmm.
There we go. Okay, just had to make the text a little bigger.
Nope. No problem. Walter and I appreciate that completely.
Oh, goodness. Okay. Read through the application, comments, notes, and overall loan request. You should make sure that you understand the loan in its entirety before moving forward. If you have any questions about the loan, you need to clarify these issues with the loan officer before moving forward. After you have reviewed the information and have a clear picture of the loan and what the applicant is requesting. Now, maybe my text is, I don't know, that doesn't sound like proper English. Picture of the loan, and it says WHIR, but I'm assuming it should be what the applicant is requesting it. That doesn't make sense. But anyway, you'll enter this information into your company's loan processing computer system. There are many programs out there that your employer will use. Many of them are a combination of homegrown software packages. However, the reason this information needs to be fully entered into the computer system is because fulfilling all the requirements of a successful loan is tedious and deadline specific. The loan processing software you use will keep you on track for the next steps that need to be completed, as well as their related deadlines. Once this information has been fully entered into the computer system, you can now proceed to the next step.
So for those of you who may have been wondering this loan file, I guess you figured out by now, based on what she said, that this file can be manual and or electronic, depending on where your entity is. Absolutely. And clearly, all the relevant information should be in this loan file, whether it's manual and or electronic. Absolutely critical, because when legal issues come up, audit issues come up, and these very critical matters come up, if your loan file is not kept properly, it will create a nightmare. And in some cases, especially from a legal perspective, it might cause you a case and cause you money as a lender, okay? Because your filing system is inadequate. Okay? All right, keep going.
Okay, number 2, the credit report. In many cases, the credit report may already be provided for you. The loan officer may have already run this report from the beginning before going any further with the loan application process. The loan applicant has consented to have their credit report pulled for purposes of evaluating their loan worthiness. If the credit report is not already attached to the file, and you'll need to double check the application to make sure that they have consented to the credit report check, and then pull their credit report. Most of the credit reports you pull will be stored electronically in your loan processing software. But if not, print at least 2 copies to attach to the loan file.
And again, before you go on, Tony, I hope you're beginning to see that as far as the loan processing is concerned, you're given a step-by-step process on all the kinds of different things that should and could exist in your loan environment to make your job complete as a lender and efficient. A lot of lenders are still have antiquated loan files. They're still not filing stuff properly. They're still not doing certain things electronically. They still have unlabeled boxes somewhere in the other building, whatever the case might be. But you can see right away from what she's saying already that this whole step-by-step processing involves a very structured procedure for best results. Of course, you may not want best results and have an unstructured process, but this is kind of typically what gives you a more structured process. Okay, keep going, Tony.
Number 3, title records and information. If you are processing a loan request for an automobile, boat, house, and so on, You will need to verify the title information. VOT, verification of title. This will not be necessary for all loans which you might handle. Title verification helps to determine if there's a lien on the object that the borrower is requesting a loan on. Number 4, verify income sources. Probably the most important step is to verify all the income assets and employment information of the borrower. You need to verify the employment of the borrower, VOE. You need to verify the income of the borrower, VOI. You also need to verify the assets listed by the borrower, VOA, and any other income information required or produced by the borrower. Every lender differs in the way you go about verifying a loan applicant's income. So be sure to follow the procedures for your specific lender. If your lender requires verification of employment in writing, you'll need to request that letter from the loan applicant's employer. For some lenders, pay stubs and W-2 forms are sufficient. And yet for others, simple verbal verification of employment by phone is fine. You need to record each verification that you have made into the loan processing software which you are using. They need me to proofread their stuff for them.
But what happened was Miguel made some blah, 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 and they didn't have,
Miguel is responsible.
I think so, because he's the one
You
who,
can send them to me. I can proofread his stuff for him.
for a fee.
Anyways, number 5. Appraisal, insurances, and inspections. If you have verified all the income and employment sources for the loan applicant, or you are far along in the process and you are only waiting for replies from the necessary parties, you are now ready to continue with any necessary appraisals, proof of insurance, or inspections. These items will vary greatly depending on the state and local laws that govern the loan which the applicant is requesting, as well as the type of loan itself. For example, if you are handling a mortgage loan, you'll need to have the property appraised, inspected, get proof that there's no termite presence in some states, and other procedures.
I know that might seem a little ridiculous, but trust me, depending
No,
on,
it's not. I just didn't expect to see it there.
yeah, depending on, and a lot of times people get stuck because this small little detail goes ignored until somebody moves in to the building that is collateral for the bank, and then it starts to fall apart because the termites start marching around. They've been there for 100 years already. Okay,
Yes.
so that is a very critical issue that is oftentimes not considered. Okay, especially in the United States and other countries where a lot of homes are still built by what? Wood.
Would, yeah.
And not concrete. Okay, for sure. Okay, keep going.
Number 6, loan file review. If there are any mistakes, errors, or oversights, this is where they need to be caught. At this point, the loan process is complete. You have obtained the credit reports for the loan applicant. You have verified all income, deposits, and employment. You have appraised and inspected the property, the vehicle, or other assets if needed. Now you need to check and recheck all of the documentation. If any of the information seems vague, you either need to clarify the information or write in an explanation as to why this information isn't provided in greater detail. This is also where you'll be able to find any red flags in the file. Be sure to highlight or note any red flags that you see before you send it off to the underwriters. Number 7.
Or your boss for that matter.
Yes.
Okay.
Number 7, certify and deliver the file. Now that you have reviewed all of the information in the loan file and are satisfied with the documentation you have provided and verified, you will now finalize the loan package and deliver it to the lender, underwriter, and manager. In summary, your file should include the loan application. This is the typed, signed application with all information provided by the loan applicant, the credit report, all verifications of employment, income, assets, W-2s, pay stubs, tax returns, and bank statements, for instance, any valuation reports, inspections, appraisals, proof of insurance, and title reports, particularly noting any liens, and any public legal disclosures that must be signed by the loan applicant. The final product should be sent registered mail to the appropriate parties, most likely the lender or the underwriter.
And of course, in the Bahamas and perhaps in most of the Caribbean countries, we just send it upstairs to the committee.
To the managing director.
Yeah, to the managing director, to the board, next door to the loan manager, whatever the case might be. So it'll vary depending on location. But you can see there's a whole bunch of stuff going on.
That goes into it, yes.
Absolutely. And all of this stuff that she just compiled in this one little paragraph includes all the other stuff that we've already done for the last 3 sessions. Believe it or not, that's how crazy this credit thing is. And we're still not done. How about that? Keep going, Tony.
Credit extensions. Many potential credit problems can be eliminated before they happen through investigation and prudent judgment when granting credit to customers. The need for sound judgment is particularly critical since credit extension policies should be neither too liberal nor too restrictive. Overly liberal policies invite excessive receivables and uncollectible accounts, while overly restrictive policies cause lost sales. Investigation. Before you decide, get the facts. Thorough investigation of credit requests protects you from the fraudulent applicant who has no intention of paying, as well as the applicant who's extremely slow in paying.
Excuse me? So really, so we don't only have like offensive, untruthful lenders. We now see that from our investigation, we have some fraudulent borrowers as well, who come in at the beginning to get a loan, knowing that they have no intention of paying that loan. When they get the money, they're going to run off with their bestest girl to Waikiki and never come back. They know they're not going to pay it. Okay? And others know in advance that they're never going to pay their loan on time. Why? Because they've had loans in the past that they didn't pay on time. They thought they got away with it. And as far as they're concerned, they're going to do it to you as well, Mr. Lender. Okay? Welcome to investigation. Yes, the borrower also has his or her fraudulent moves. All right, keep going.
Credit applications. The basic source of information for decisions on credit extensions is the credit application. There are 3 major factors to consider in evaluating a credit application. The first is the applicant's ability to pay based upon income and obligations. The second is willingness to pay, which can be determined from the applicant's credit history. The third factor is potentially profitability of the account. You stand to lose your cost of the product or service sold to the customer if you cannot collect an account. If your cost is relatively high compared to the selling price, then you have to be particularly careful in assessing credit risk.
Keep going. Well, of
I
course,
think I want a little bit of explanation on that.
Yeah, of course, in this case, we're talking about the company, not the individual. And basically what we're saying here, if the company is operating at very high cost for inventory, for salaries, or whatever that cost is, then sooner or later, and they're not generating enough sales to cover those costs, sooner or later the company is going to start to suffer losses. And then when they start suffering losses, then you're going to start seeing your loan payment coming in slower and eventually not at all. And there's a possibility that depending on how high those costs go, how poor those sales are, that the company itself might end up closing its doors. Okay, that's what that means. So this high cost, this company that's operating at extremely high cost, any experienced lender would be able to recognize that this has to be taken into consideration as far as the credit risk is concerned. And if it's too high in their opinion, they're likely perhaps, if all other things are equal, to turn down that loan. Okay. All right, keep going.
Okay, application evaluation. Your evaluation of any credit application will depend upon several factors, In the case of an individual applicant, you will want to consider the following: employment history, current position, current income, time on the job, job security, monthly obligations, rent, loan payments, food, utilities, etc., bank balances, personal assets such as house, cars, stocks, bonds, etc., credit standing, amount of credit desired. Information verification. Information on credit applications must be verified to ensure that it is correct, current, and complete. A good place to begin is the place of employment to verify the applicant is employed and that the income and time on the job have been reported accurately. Bank references should also be verified. While laws restrict the amount of information that banks can disclose, checking on this information can protect you from obvious fraud and may give you some indication of the applicant's ability to pay. Most banks still confirm the existence of an account and disclose a broad idea of the average balance. The bank may also indicate whether the account has been satisfactory.
Question before you go on. How in the world, anyone, can a bank reference? Why would a bank reference have to be verified? It's coming from the bank.
Yes, fraud happens in banks.
Yes, who said that? Doggone it, Lisa. Of course, fraud happens especially in banks. So the fact that it came from a bank doesn't make it fraud free. You still have to check. If something comes from the Pope, because it's the Pope doesn't mean you shouldn't verify it. The Pope may have been lying.
Wow, I learned something tonight.
Absolutely, popes lie too.
No, not that. I'm talking about verify the bank references.
Absolutely, and I know exactly why you say that, Tony, because a lot of us have this notion that because it came from the bank, the bank, the holy grail, the bank, that everything is in order. That is not true. Please, if you're doing a credit facility, do not be bashful to check it out. Do not worry about it if you call in and they say, you doubt our position. No, not really, and just verifying. See my point? Because
Yes.
sometimes people are involved in banks in fraudulent activity. Exactly how Lisa said. In
I
fact,
never thought about that.
Isn't that amazing?
So moving forward, I will verify the bank credit reference.
No, a lot of us don't. We see the Scotia Bank, man, we still have the loan file. The same thing.
We don't ever do it.
No. Royal Bank, oh my God, we just throw it in the loan file. Remember, we are still in the loan file.
Never even thought about it.
We don't think we verify, hell no. It's just like for what? They are the holy grail of truth. It's one of them, see? But that's not necessarily true. There's somebody in one of them, see? Somebody in one of them. One of those places might indeed be up to no good, just as Lisa said. All right,
Yeah.
fine. Credit bureaus, that thing. Keep going.
Ready for me? Okay, credit bureaus. An important source of information for retail credit is the local credit bureau, which generally provides information on credit applicants to firms that are bureau members. Annual membership fees usually depend upon the size of the business. Besides the membership fee, there is a nominal charge for each inquiry on a credit applicant. Your local credit bureau will provide you with details about services and costs. Stability. In situations where the time or cost of a comprehensive credit check is prohibited, professional credit managers have often found that a quick evaluation can be made based upon the applicant's stability. Stability is determined by the length of continuous employment and residence. This assumes that the person who has been employed for several years on the same job will most likely continue to be employed and therefore will be able to pay. Similarly, continuous residence indicates a desire to maintain standing in the community.
Of course, if somebody's been on a job for 15 years and they open a newspaper and they see an ad for a position that pays more and they decided to go, they might decide to take the risk, like Lisa and I were discussing, and leave their 15-year job for the probation thing. And then the day before the probation is up, they are told that they did not meet the standard for the company. They're not a good fit. They're just not a good fit. And so now they are in trouble. And
Unemployed.
so, yeah, and so is your loan. Indeed. Okay.
Yes.
Of course, these are the kinds of conditions that we cannot always anticipate, but they do occur more often than we would like them. All right, keep going.
There are no hard and fast rules that can tell you who is a good credit risk and who is not. There are cases where the poorest of people pay their bills promptly, while the wealthy ignore them. That's facts.
That is a fact.
I can tell you.
So
As
can
the
I,
owner of a small business, you must combine facts about the applicant with common sense to determine those risks that appear reasonable.
all right, and that goes for any particular lender. It's a simple summary, but it's a truthful one. After all the work is done, at the end of the day, you can only use your best judgment, preferably given the information that you have collected and verified. See, it's not all gut feeling. It's based on information that you have collected, verified, and analyzed. And then, based on all of that, you make a decision to the best of your professional ability. Okay. All right, we're going to stop there. I'm not going to go another step. So none of your questions will go beyond this point. So please, you still have
We can't add equity to that.
You want to add stuff, Tanique?
I think equity is important.
Oh, well, we're going to cover equity on the next slide after your exam.
Okay.
The part that we didn't cover, we'll do, and then we'll go into the collection side. Collections is not that long, so I'll save equity and a couple other interesting things for the other side. Okay?
Please forgive me, Marissa.
I just want to tell you, my brain done been sleeping long time.
Yeah, Marissa's just gonna let something rip like equity. Are you kidding me? I don't want to hear nothing.
Girl, I'm so tired.
But that's okay. You guys have been super troopers. Remember, I know a lot of things are going on with everybody. I don't know where the Nigels are, nor the Phillips. They're off somewhere. I guess they have a plan. But remember, today is Wednesday. We all have a bunch of things going on. Your exam is next Wednesday. So from here on in, you keep chugging. This weekend, if you don't have anything critical to do, use this weekend to solidify all the key stuff that you need to know. This weekend.
Mr. Wilkinson.
Yes.
Can you please send me that information that I asked you about earlier?
Yes, my foot. What was that again?
Tanique Clark. No, ask Walter.
Hello?
Walter.
Say it again.
What should I ask?
It's a joke.
Oh.
Oh yeah.
She can't take it from my account.
Yes, it takes a debit his account.
Yes.
Oh wow.
That's it. Debit.
You have verbal authority.
Yeah. You have a spoken word that you can debit his account. Now you move forward at your own risk.
That is so interesting.
I think you've studied enough, even in credit collections alone, to know that you must temper that risk as you move forward on his verbal instructions. But believe it or not, there are a lot of people who still act on people's verbal instructions. Do you know that, class?
Yes, I know.
They do, unfortunately. All right, so good luck to you guys. Give it your best shot for next week. If you make your usual commitment to study, you'll be fine. There will be no surprises, no questions asked beyond this point. I'll see you guys next week, Wednesday, 6 o'clock at Biff's Center, ready to go.
6 or 6:30?
6:30 is better for you, Walter?
6:30 is better for me.
Okay, 6:30. I'll just let them know we'll be using our usual time. 6:30. Okay.
Okay.
All right.
Mr. Wilkinson, please send the information. Thank you.
You're quite welcome. Okay. You
Okay,
guys,
good night, everyone.
good night and be safe.
Okay, good night.
Good night.
Good night, good night.
I don't want anybody catching anything before next Wednesday.
In Jesus' name, amen.
Amen.
Good night, Melissa. You guys take care.
All right, good night.
Okay,
Good
good
night.
night, Melissa. Take care.
Good night.
Good night, Marissa.
Good night.
Philip, there you are. Good night. Did you get all of that?
Good night.
Good night. Good night. Take care. Okay, I see Nigel Conlett joined us. Okay. Mark him present.